Good morning. Another brief update for you today. We'll start with just a few basics with regards to what's been happening within markets, which is always interesting. As you know, every single day I get up and do the math of the market, which is a computation of price, volume, and volatility. Volatility being the primary driver behind all that. And volatility has certainly been breaking down recently. It didn't break down into a level that would be consistent with markets just flying sky high. It's broken down into an area of what we call a chop. And when you get volatility breaking down into the chop, what it means is that there's a high likelihood that it just oscillates somewhere between on the VIX of 21 and 28. And when it oscillates back and forth between those levels of VIX, what will happen is price in markets will typically move inverse to that. And so what that means is that we want to buy at VIX 28, we want to sell at VIX 21 or get close to it. And so that's obviously a new development. Another new development that has been happening are tremendous amounts of implied volatility discounts. Now, I don't want to get too deep into what all that means, but basically in the options market, it prices in complacency or it prices in fear. And interestingly, for the past 3 to 4 days now, we've had relative highs on implied volatility discounts, suggesting that that pretty much everybody is complacent. Complacency in markets usually isn't a good thing in terms of driving price forward, but what it does do is it gives us an opportunity to enter into some of the long positions that we want at just much better prices. So what do we want? Well, the market is sniffing out what we would call a quad 2, or growth with accelerating inflation. And so that means the commodity plays that we have been mostly long of since June, we want to continue in that round. Currently we're long in some of the commodity plays, corn and wheat and natural gas. Natural gas is getting speed bagged this morning for really no good reason. Which, that happens. We don't get every single one of them right, and that's fine. We just basically buy more at the low end of the range when that happens. And so when that happens, like today, we'll just continue to gross up our position at a better basis. Eventually, natural gas, certainly going into the winter, will bounce, and as it does, it'll give us an opportunity to unwind that position at a better price. What is happening, though, as this market continues to sniff out quad 2 growth with accelerating inflation, is the interest rate cycle has dramatically changed. And what I mean by that is that we are now very clearly in an environment where it's rising real rates along with rising nominal rates. In other words, the 10-year Treasury is more likely than not to continue to increase its rate-bound movement to the upside, and it's more likely than not that real interest rates continue to rise. The two things that hate that kind of an environment are, of course, Treasuries and gold. So, as you've noticed, we haven't owned gold for quite some time now. Excuse that. That was actually one of my alarms for paying attention to the particular of the moment, which in this case is one of the commodity plays that we'll add to. But beyond that is rising real interest rates continuing to move to the upside, which is very negative for gold. So we don't own gold at all. In fact, gold is at this point in time a net short, meaning if we want to create alpha in the portfolio that allows for the risk of shorting a position, then we are looking towards doing that with gold, depending upon how some of the math develops here over the next few days. So long story short, all we're attempting to do is risk manage our current positions by waiting and being patient for the math to hit the low end of the mathematical range, for some of these implied volatility discounts to wash out of the market into premiums, and allow us to enter into some of these positions at a better price, while at the same time staying away from gold and treasuries. In terms of fixed income, the things that we would be using moving forward would be things like convertibles, treasury inflation protected securities. We have a position symbol IVOL that we use because it's also what we call a yield curve steepener. And that steepener just simply means that as the yield curve steepens, as 2-year treasuries get lower and 10-year treasuries get higher, what that does is it's a predictor of economic activity. And what it's saying is that it's strongly suggesting that Quad 2, Quad 1 movement is happening. So again, Quad 2 is growth with accelerating inflation. Quad 2 is growth with decelerating inflation. That's kind of Goldilocks. And if we were to get that, well then, of course we would want to take advantage of that. So in terms of where we are right now, let me just share my screen with you if possible. Let me see. Yeah, so here's my screen real quick. This is a picture of volatility. So what we basically want to do is we want to buy equity positions at VIX 27, 28. We want to sell VIX or equity positions, or at least minimize some of the risk exposure down at VIX 21. So, everything right now, as is usually the case, is about being patient. Same thing is true with NASDAQ positions. We want to buy at VIX 30, VXN 31, sell at about VXN 26, 27, somewhere in that range. A few things that we're looking at adding to the portfolio right now, because they are in fact on sale and at the low end of the range, would be utilities. We do want to add technology, but we want to wait for technology, but we want to do that at a time where it's at the low end of the range. So I'd kind of like to see the NASDAQ get down to about 11,550, 11,600, somewhere in that range, and then we would be buying some of the QQQ, which is the NASDAQ 100. We would be buying some of the Direct Technology Fund, which is XLK. We own a little bit of IGV, which is the software index, which continues to do well, even in the face of a currently broader market that is down slightly. So, we want to increase our technology plays. We want to increase some of our commodity plays, like, for example, corn and wheat, both of which are on sale today. We'll probably buy cattle and pigs, which, again, we would be willing and interested to buy down towards the mathematical low end of the range, which is down in this representation here at this blue line that you see right there. Beyond that, as I mentioned, utilities. There's also some consumer discretionary type positions that we would be interested in taking, like this. But beyond that, energy. Energy continues to be an increasing bullish play, and it really is a function of what's going on in the oil market. The oil market is signaling bullish trend. If West Texas Intermediate gets down to around 38, 38.50, then I'd want to take a position in things like XLE, XOP, which is exploration and gas. Of course, we could take a position in Brent oil itself, which is this one here. So there's lots of opportunities to be able to gross up our net long positions in the portfolio, which we will take advantage of. And we've just simply been in a position where volatility measurements across asset classes have been very, very difficult to deal with. And so that's why we've been focusing on asset classes other than, in many cases, than just U.S. equities. We continue to have positions in Japan, Taiwan, China. Let me share those with you real quick just so you can see what those look like. So this is Japan. Anytime Japan goes on sale, we basically want to continue to gross up and buy some. So Japan's up today. China, we added some Chinese equity exposure yesterday. Again, anytime it's on sale or red is when we add some to the portfolio. Chinese internet, again, bought some more of this yesterday here. And so we just want to continue to gross up these positions, but we want to do it at good prices, which are, again, when they're down. Taiwan continues to be a good play, as does Finland, as does Norway. And on top of that, of course, with the oil play, would be Russia. So we're just going to wait for some of these to get more towards the mathematical low end of the range to provide us that entry opportunity, which may or may not be too far away. But the biggest key with risk managing the portfolio, of course, is patience. Patience for any position that we want to enter, because it is a bullish trend. is to wait for it to get to the low end of the range, wait for some of those implied volatility discounts to wash out and move towards premiums, and then we can start to enter into it. So certainly in probably not too long of a time frame, we'll see the portfolio start to expand out into some of these other asset classes. Right now, what of course is controlling a lot of the movements, the U.S. dollar, and the U.S. dollar is certainly in a cycle of devaluation, and that cycle of devaluation ebbs and flows between lows and highs and lower lows and lower highs, as you can see kind of depicted by these circles here. So the low end of our mathematical range on the dollar a couple of days ago was pretty much right about here. So there are a lot of asset classes that are inversely proportional to the movement of the dollar, including and not limited to the S&P, to commodities, Bitcoin, things of that nature, but also foreign commodities. So recently we had positions in the Japanese yen. We took a position in the yen here, and we actually sold the yen in this range here. And we also had a position in Swiss francs, bought it here, sold it up here. And so the reason why we were able to do that is just simply because we watch the currency pairings. So there are a number of ways in which we can express a dollar down kind of movement, and one of the ways is to involve foreign currencies in the portfolio. There are alternatives to stocks. Foreign currencies and the U.S. dollar, of course, have a much less volatility quotient, volatility measurement than U.S. equities. And so when the opportunity provides to enter into one or more of those because they're at the low end of the mathematical range, because the dollar is signaling an overbought condition, we're not there yet. If DXY, which is the dollar index, gets up to about 93, that's when we would start to increase our U.S. dollar short position. That's when we'd consider looking at some of these other currencies like the yen, the franc, the British pound, things of that nature. And also at that point in time to look at adding to our equity exposure and things of that nature. Again, those inverse correlations on a short-term basis matter. So we get the dollar right, get a lot of other things right. And as I said, with VIX between 21 and 27, it is not like having VIX between 15 and 19. Those are very, very different environments. And so it still requires a risk management process. It's not a buy and forget about it kind of environment in my mind. And so that's why we continue to work through that process as the economy continues to move through a very arduous and in some respects still uncertain scenario. Lest anyone forgets, we still are dealing with an uncertain election. We're still dealing with an uncertain outcome as it relates to how people's response and reactions to this pandemic will be. States across the board are continuing to and adding to the shutdown process. Schools are closing down. New York schools closed. Of course, that impacts restaurants and bars. That impacts a whole host of economic activity. So how will it play out? I don't know, but what I do know is that the math will allow us to be risk managing the process as effectively as possible. I would rather be very heavy in cash and wait for some of these developments to play out and get it right than, of course, to get too much volatility in the portfolio, causing net problems and strain. So it's one day at a time, one thing at a time, one process at a time. And as we continue to work through that, we'll just do as best we can to work through it. So if you have any questions at all, please, by all means, give me a call or an email. Email Chris at careformywealth.com, direct line 608-354-1977. Always thankful to hear from you. No such thing as a silly question. Let me know how I can help or how I can explain any of this stuff better. Just let me know. So again, thanks so much for allowing me to work for you and your family, and hope you have an amazing day. God bless.